Reciprocal tariffs and the Great Reset. Gold challenges the 10-year as the global risk-free asset. Summary statement. As the U.S. deploys reciprocal tariffs to regain trade leverage and reinforce dollar demand, a deeper transformation is underway. BRICS nations, led by China, are positioning gold as a new benchmark for global reserves. By placing a policy-implied floor under gold prices, they offer capital gains as a substitute for yield, challenging U.S. Treasuries as the world's go-to risk-free asset and signaling a broader shift toward a multipolar financial order. Introduction, a new chapter in global strategy. Tariffs are back, not as a fringe protectionist policy, but as the spearhead of a broader U.S. economic strategy. While many commentators frame recent U.S. tariffs as politically motivated or inflationary, they miss the deeper play unfolding beneath the headlines. The world is witnessing a reconfiguration of global capital flows, reserve asset preferences, and the very nature of what constitutes safe or risk-free value storage. At the center of this shift is a quiet but powerful confrontation: U.S. Treasuries versus gold, Wall Street versus real assets, and a unipolar order versus a multipolar future. As the U.S. seeks to reassert dominance through access control and reciprocal trade enforcement, China and the BRICS coalition are crafting an entirely different value proposition, one based on sovereignty, stability, and non-yielding appreciation. This is more than a trade war. It's a monetary and narrative realignment. 2. Weaponizing access. The U.S. domestic market as leverage. For decades, access to the U.S. market was treated as a given. Goods flowed freely into American ports under the logic of globalization, while the U.S. absorbed trade deficits in exchange for global influence. That era is ending. Through the reintroduction of reciprocal tariffs, the U.S. is transforming its domestic consumer base into a strategic asset. Foreign exporters are now required to pay to play. The underlying logic is simple: rebalance trade, restore domestic production, and increase demand for U.S. dollars. And it's working, at least in the short term. U.S. Customs and Border Protection has already begun collecting over $200 million per day in additional tariff revenue under the so-called Liberation Day framework. Meanwhile, global demand for U.S. dollars is reinforced by countries needing to buy American goods, either through currency exchange or dollar accumulation. This pressure also supports U.S. Treasuries by increasing demand for dollar-denominated reserves, indirectly bringing yields down. In fact, following recent tariff announcements, the 10-year Treasury yield fell to a 6-month low of 3.889%, underscoring how financial markets are already responding to the new structure of enforced reciprocity. 3. The collapse of the traditional trifecta. Historically, U.S. financial hegemony rested on 3 pillars. 1. The petrodollar, where global oil transactions reinforced dollar demand. 2. U.S. Treasuries, seen as the world's safest yield-bearing asset. 3. The U.S. stock market, a capital magnet offering liquidity, innovation, and growth. But all 3 are under pressure. The petrodollar era is quietly ending as Saudi Arabia and other OPEC nations begin accepting alternative currencies like the Chinese yuan. U.S. Treasuries are being offloaded, with China cutting holdings from over $1 trillion to under $900 billion. Countries like Japan are showing less appetite for U.S. debt, especially after the U.S. weaponized the financial system against Russia in 2022. The U.S. stock market, once a symbol of unshakable confidence, is no longer viewed as a reliable store of long-term value in a volatile and politically polarized environment. This creates a vacuum in global capital preservation, one that China and BRICS are eager to fill. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. IV. The rise of gold as a strategic reserve asset. BRICS nations are responding not with a new digital currency, but with an old world standard retooled for a new era: gold. Central banks across the BRICS bloc have accelerated gold purchases, not simply to hedge risk, but to anchor a new system. Through quiet policy coordination, China appears to be placing a floor underneath the price of gold, turning it into a non-yielding asset with reliable capital appreciation. In this model, gold becomes the new risk-free return, not because it pays a coupon, but because price stability and long-term appreciation are effectively engineered by its backers. For countries that fear U.S. sanctions, asset freezes, or politicized institutions, this offers a politically neutral and trustless store of value. China and BRICS are effectively introducing a new benchmark, a non-yielding, appreciation-driven store of value that rivals U.S. Treasuries as the global risk-free asset. This shifts the global reserve logic from income generation to capital preservation through appreciation, a new kind of risk-free paradigm in a fractured financial world. The AI front, disrupting the U.S. tech narrative. Parallel to gold, China is launching a second strike, this time at the heart of U.S. tech dominance. Through companies like DeepSeek AI, China is undercutting the U.S. investment narrative that previously fueled immense flows into companies like NVIDIA and the rest of the Magnificent Seven. By rapidly open sourcing advanced models and offering low-cost access to their AI stack, China is disrupting the monetization layers of the U.S. AI boom, blunting Wall Street's ability to pitch AI as the next great yield narrative. This is economic warfare via commoditization, turning exclusive U.S. innovations into low-margin, widely accessible tools. The impact is psychological as much as financial. If AI is no longer proprietary, then U.S. tech is no longer the future. VI, the emergence of a multipolar financial order. This moment is more than a challenge to the U.S. It's the dawn of a multipolar framework. China's Belt and Road Initiative is not just about railways and ports. It's a scaffolding for regional trade zones, financial independence, and long-term partnership. Unlike the West, China isn't imposing political models or military bases. It's exporting infrastructure, capital, and optionality. This ethos is spreading. Countries are increasingly seeking peer relationships rather than top-down directives. The weaponization of everything, from finance to access, is reaching diminishing returns. The age of belligerence and control is giving way to a new age of constructive self-interest. Conclusion: the Great Reset in motion. Tariffs are just the surface. Beneath them lies a full-scale redefinition of value, trust, and reserve logic. Gold is no longer inert. It's a policy-shielded asset with rising value. U.S. Treasuries are no longer sacred. They're political liabilities. And the concept of the risk-free rate itself is evolving from a yield on paper to a price floor on real assets. The U.S. may win a few rounds through coercive tools, but in the long game, trustless stores of value and open systems may prevail over centralized power. The Great Reset is not just financial, it's philosophical. In this new game, the issuer is no longer the asset. Trust is.